But let's talk about the Network 18 numbers. Standard disclosure there, of course, owner and producer of the channel. But this time around, there has been an improvement. Net sales up 4.5% year-on-year. The margins for Network 18 have improved to 8.4% versus 1.5%. Sai Kumar, the group CEO of Network 18, is joining us here in the studio. Sai, hi, good morning and good to see you in. First, let me talk about the advertising revenues. Those grew about 3% in this quarter. It just give us an expectation of whether you expect this pickup to continue and what could the ballpark range be, because last year you had predicted a zero growth. Is the revival now starting to kick in?
Oh yes, absolutely, and I see that we're coming out of perhaps one of the most bleak periods in advertising. It's been enormously soft, to put it mildly. But that said, we see green shoots. I see a turnaround in advertising across sectors. When I say sectors, in broadcast parlance, I mean entertainment, infotainment, youth, music, and of course, news. You will see this improvement partially in Q4, but I see a large part of this moving into next fiscal.
So, will the elections and budget be something good for the news segment?
Well, these are nice peaks to have, but I'm talking about organic growth in advertising. So these are extremely topical. So I see advertiser interest going up, I see viewer interest going up. But as a theme, while last year we guided that advertising is going to be seeing a degrowth, we believe that now we're on the way back.
What about subscriber revenues? I mean, y'all nowadays declare only net subscriber additions. Right. So I guess you deduct carriage fees.
That's right.
If you can tell us something more about subscriber revenues and more importantly, trajectory. I mean, we have this big theme, digitization is going to improve revenues. So if you can give us the trajectory.
So here's the trajectory. Now that you're talking to me about our subscription income, let me just focus on the broadcast piece. The broadcast piece has seen net margin increase of about 70%. We moved from about 40-45 crores to about 70 crores. A lot of this has come on the back of net distribution income. And I've said this for the last many quarters, this has been our theme. One of our weakest areas as a broadcast company was distribution. All the good work that you do, households were never getting, or rather households were paying us, we were never the beneficiaries of that payment. But net distribution income, we are focused on what the cable operator pays us after deducting carriage. And you're talking about trajectory, we delivered about 140 crores of pure upside last year, and we're in line to deliver an additional 140, 150 this year. So this is just domestic NDI. On top of that, our international ad sales and subscription is growing at about 40% year on year. So that's been the really good news. So if I were to just headline this, I think domestic NDI and international sales, syndication and subscription have driven most of the growth. Advertising continues soft, and then there were measures taken to have a common backend for our news infrastructure. That has ensured that our news networks today operate at a cost which is 10% lower, which I believe will ensure sustained profitability for the news networks, irrespective of advertising growth or degrowth.
You're saying, are you giving me a number for net distribution income? I mean, I'll tell you why the worry comes. We have seen even DTH operators, we saw the recent tussle, they're also trying to charge more for content, so carriage fees.
Yes.
Therefore, how do you tide over this hump? Can you give us any guidance, visibility on net distribution income?
Well, net distribution income, we had guided about between 125 to 150 crores of an increase this year, and we are completely in line.
Okay.
As far as these TIFs go, I think, we're not doing our jobs well if we don't have a TIF like this every quarter, because that's the only way you'll reset your business.
Okay. Well, I'm going to ask you a tricky question. Last time we spoke with you, you said that this consolidation of the business will continue, but now there are a lot of new channels that are getting launched by the management. I want to understand how that may actually impact the margins, and whether all the cash flow that is being generated will be used in order to launch the new channels, which is the concern that some people on the street have.
Well, you got that right. Of course, it's tricky because, a year and a half back, TV18 had gone to the markets and said that it's going to be focusing fully on profitability. We had come out of an expansion phase, a 4 or 5 year expansion phase. Today, we're completely in line to profitability. If I take you back, we moved from minus 60 crores to plus 112, and we are moving steadily towards getting as close to the 200 crore mark as possible this year. But that said, you're in the broadcast business, you're a large network, there are opportunities all around you. So we are now changing the guidance a bit to profitable growth. We are looking at those channels where our investment losses would be minimal or none at all.
Which are?
For example, CNBC Gujarati. I believe that CNBC Gujarati is an enormous opportunity in the market. I think we're about a year late to the party, but you have to make these decisions keeping in mind imperatives of P&L management. But now we are very confident that CNBC Gujarati will be launched, like MTV Indies is going to be launched. And we will stick to our profit guidance despite these launches. So we are now, going out with a whole new term called profitable growth. In the past, new channels, you're absolutely right, meant investment losses. This time we're saying new channels, but sticking to guidance.
But expansion will add to the operating costs, will add to interest costs, and this time you've seen a bit of a recovery. So is that something that we should not expect going ahead? Recovery in interest, reduction in interest costs?
Our interest costs have come out materially, as you would see.
Yeah.
And so I don't think they are a dampener anymore.
Okay.
Now you come to operating costs going up because of new channel launches. If you deep dive into operating costs, there were two large components. Component number one was carriage. With digitization, our carriage costs have gone down. Indiacast is now bargaining power in the market. Number two was subscription. Our new channels are now getting into the subscription meters much faster than in the past. These are the two fundamental propellers for ensuring that the operating revenues match or more than match up additional operating costs. Also remember that here is a network that has enough synergy to absorb these expansions, be it distribution synergy or infrastructure synergy, or for that matter, ad sales synergy.
Okay. Well, we are running out of time. We're being warned. So, digital content, that one is still, posting losses at an operating level. In fact, while it has fallen year on year, quarter on quarter, it's risen from 9 crore to 14 crore. What's the plan? Will you all monetize more, or do you see the losses itself reduction?
Oh, absolutely. Let me answer this question as a digital piece. Digital content and commerce. We have seen perhaps the most spectacular turnaround amongst all our businesses. Last year on a whole fiscal basis, I mean, these were losses that were more than 100 crores. This year, it'll come to about 1/5 of that. Okay. And I'm seeing a big trend in digital monetization. I'm seeing a big trend in e-commerce profitability. If you looked at Network 18 results, they were really TV 18 results reporting up and losses coming in from our digital pieces. Yeah. That you will see will change. So TV 18 is getting profitable. That's reporting up to Network 18. And digital, inshallah, is getting profitable, and you will see that very soon.
So you will see black this quarter itself, or are you seeing black in a couple of quarters?
You will see black progressively soon.
So the sum and substance is TV 18 is your precious cash cow.
Well, and within TV 18, CNBC does a great job.
All right.
Sorry, that's CNBC TV 18 before I get censured.
Fair enough, Sai. Okay, our producer has been reminding us that we have gone too much over time. Thank you very much for joining us. And to remind our viewers, Network 18 is the owner and producer of the channel that you are watching. So that's the usual caveat.